Good morning, good afternoon, and welcome to this session of the Yellowbook training series. Today we are joined by Matt Geerdes and Jim Savio. Before we hand it over to them, I do want to go over some quick housekeeping items. I'm Rachel Windett with Sikich University. I'll be on to support you all today. We're also joined by Chelsea Kim. We will be screening the questions and comments as they come in. For CPE today, we will have 3 polls. They're going to pop up throughout the session, so make sure you complete all 3 polls to receive CPE credit. Should you have any issues, let us know in the Q&A and we'll get you squared away. This recording will be made available on demand in a few days following the event. You'll get an email with that information. So to introduce our facilitators, Jim Savio has been with us for 30 years. He has participated in hundreds of audits of municipalities and other governmental units in that time. He is responsible for providing technical services to Sikich's governmental clients in all areas of governmental accounting, auditing, financial reporting, revenue and expenditure forecasting, as well as cash and debt management. Matt Geerdes is a principal with us as well. He's been in public accounting for nearly 24 years with providing auditing and consulting services. He works closely with entities and local government and not-for-profit sectors, including municipalities, state agencies, and state universities, community colleges, school districts, special districts, and educational foundations. So without further ado, thank you all for joining us again, and I will hand it over to Jim and Matt.
Thanks, everyone. Thanks for joining us today for session 6 on compensated absences. Probably everyone's favorite topic about right now, since most people have probably just finished or are in the process of implementing GASB 101 on compensated absences. So like Rachel said, I'm a principal on the local government team here at Sikich. So I'm going to give you a brief overview of kind of what we're going to discuss, and then I will dive right in with the presentation. So I'm going to cover just an overview of GASB Statement 101. After that, I'm going to discuss some implementation tips and kind of tips on accounting for compensated absences on a go-forward basis. This is going to be like basically high-level tips into, just things that will help you out with the implementation. So Matt's going to follow that with a little bit of a micro level, common issues, obstacles, and questions during the implementation. So when you're getting into the nitty gritty, the hands-on implementation, he's going to have some common issues and obstacles that he'll talk about. After that, we will go into a review of the case study. Matt will do that. And then at the very end, we'll review the financial statements and footnote examples. So that kind of gives you a high level overview of what we'll be presenting today. So without further ado, I will dive right into the slides. I'm going to turn my camera off so you guys only have to hear me ramble on instead of see and hear me ramble on. So the what, why, and when of GASB Statement 101. So the previous existence was GASB Statement number 16, and I did some extensive research and found out that this was issued in 1992 and was effective for fiscal years ending June 30th, 1994 and on. So this was even before my time. So that's how old it's been since we've revisited compensated absences. But when you think about it, a lot's changed in that 30 plus years. Back in 1992, I don't think the concept of paid time off or flexible time off was around. Pretty sure like unlimited leave was not around at that point. So a lot of new types of compensated absences came out in the last 30 plus years. So there's also some clarification on certain other types of leave too, including sabbatical leave that we will talk about shortly. And it's effective, like I said, for fiscal years beginning after December 15th, 2023. So your fiscal year, December 31st, 2024, and thereafter. So like I said, we are right in the thick of implementing this particular pronouncement. So So what is a compensated absences? You'll see on that box on the left, uh, shows you what makes up compensated absences under GASB 101. And the big thing that changed from GASB 16 is that first bullet point, cash payments when the leave is used for time off. So that's a change from 16. Basically 16 picked up points 2 and 3. So if it was used for time off, we didn't pick it up previously. That really is the big change. So the other cash payments upon separation of employment and then non-cash settlements, like I said, those were picked up under 16. So that's what a compensated absence is defined as now under Statement 101. And then the box on the right-hand side just gives you some of the examples. So vacation and sick leave, paid time off, holidays, parental leave, military leave, bereavement leave, and then certain types of sabbatical leave. This is only for unrestricted leave. So this is unrestricted means like basically you don't have to do anything. Like you're getting up at noon, you're binge watching The Bear, Ted Lasso all day. You got nothing to do. So that was what an unrestricted sabbatical leave is. And by the way, those are just examples. I've never personally done that. So um, an example they give of something that wouldn't be unrestricted would be if a university professor um, has a sabbatical from teaching but is doing research. They're still doing something for the university. So in that case, that would not fall under GASB 101. And you can move to the next slide. So basically, compensated absences is going to be leave that's attributable to services that are already rendered. So the employee has already performed those services required to earn that leave. And the leave has to accumulate. So it basically carries forward from the period in which they earned it. They can carry it forward to future reporting periods when it'll be either be used or paid or settled. And then finally, the leave is more likely than not to be used for time off or otherwise paid or settled through other means. So I love GASB's terminology. They have more likely than not, reasonably certain. So more likely than not just basically means that the likelihood is more than 50%. So when you're determining the balances of compensated absences, you're going to evaluate by assessing the relevant factors. And when determining what the balance is going to be, I would say most governments have looked to historical information on use and payment. So they're looking at usage patterns from the previous, 2 to 3 years. You're going to look at your policies, whether leave's eligible for future use, and then also look at information that may, you know, contradict historical information, and it may make that historical information not accurate for the future. So something may have changed, like the policy, something like that. So you want to look at all those things, but as we'll talk about in a bit, most governments are using historical information based on usage and payment to come up with their compensated absences balance. So there are some exceptions uh, to recognition under GASB 101. So leave that's more likely than not to be settled through conversion to a defined benefit post-employment plan. So defined benefit, not defined contribution. This will typically be excluded from the liability because the actuary usually bakes that information into the liability that they're calculating for that defined benefit plan. So the one thing I will say on this is you probably want to confirm with the actuary that they're actually taking this into account, because there's been instances where they actually have not taken that into account. But if they are doing that, you can exclude it because it's already included in their liability. Also, leave that's dependent on occurrence of a sporadic event that affects a relatively small portion of employees in a reporting period. You would recognize that only when the leave commences. So that's going to be, parental leave, military leave, jury duty. So This does happen, frequently. There are some governments, that have military leave, and it may cross over different reporting periods. But typically, this is like like it says, it's only going to be a few employees, and usually the leave is not an extended period of time. So a lot of times, it's not going to rise to the level of materiality. So typically you want to consider it, make sure it's not material, but a lot of times this, you probably won't need to record anything with this. And then finally, unlimited leave, which is basically leave where there's no set amount. They may recommend that you take a certain amount of leave, but there's no set amount, so there's nothing really to measure there. You're not going to include that, and any holiday leave that's taken on a specific date. So 4th of July, Labor Day, that you have to take the time off on that specific date, you're not going to include that. If you do have some governments that have floating holidays where they could take those days, then you're going to have to take that into consideration under GASB 101. And then how do we measure it? So you're going to come up with your balances, compensated absences balances as of your fiscal year end, say December 31st. And then you're going to multiply that generally by the employee's pay rate at the financial reporting date. So it's the pay rate as of 12/31. The exception that they have, and this can be kind of confusing the way it's written in 101, and I've seen a lot of people, be confused by this exception, but it says if it's more likely than not to be paid at a different rate. So what that basically means is it's not going to get paid out at 100%. It's going to get paid out at 50% or 25%. That's what they're saying by a different rate. It isn't, in this example, that they have a pay increases on January 1st. So it's going to get paid out at that rate. You should, use the pay rate at January 1st. That's not what it means. What it means is pay rate as of December 31st. And if it's paid out at less than 100%, you use that rate. If the pay change at January 1st, that would be recognized in the period of the change, so in the next fiscal year. So you're going to multiply by that pay rate. You're also going to include certain salary related payments, both directly and incrementally related. So directly related basically means that it's a function of the salary. So it's dependent on the amount of the salary that's paid. And then incrementally, it's just like an additional payment that's made in addition to your salary. So a defined contribution pension or OPEB would be recognized as that related leave is earned. You wouldn't record it as a pension or OPEB liability. It would just be included in that compensated absences liability. The expense side you can show as a pension expense or OPEB expense, but liability, just include it with the compensated absences balance. And then defined benefit pension or OPEB, as we said, that's going to be excluded. And we're up to our first polling question. How exciting.
So I have launched that poll. How many different types of paid leave does your organization offer? So as a reminder, we do require all polls to be replied to for CPE credit, so make sure you complete this. Give everyone.
It looks like 3 to 4 is going to win.
Yeah. Give it a couple more seconds so everyone can get that in. All right. So yeah, with 49%, we have 3 to 4.
I would say that sounds about right. Nothing too surprising there. So our little hodgepodge of miscellaneous items with GASB 101. So that first bullet point, this would be if you had like an employee leave pool, which actually quite a few governments do have it, more than you would probably think. But this would be if you have a pool where people can contribute like their sick time, additional sick time that they have or that they don't use. They can put it into a pool, and then another employee that had to take a lot of sick days can kind of borrow from that pool. So in that instance, you want to measure the liability using the pay rate that's representative of the eligible employee population. So an average pay rate, a weighted average pay rate, something like that to come up with that. So these actually do exist in practice in government. What I would say though is you want to look and see what the utilization rate is on it, because typically it's not used very often at all. So it may be something where it's never utilized, so it doesn't meet that more likely than not. So you may not want to record anything related to this. If it is used quite often, then obviously you do want to include that in your compensated absences liability. Second bullet point I already talked about, but that change in the measurement of the liability due to a change in the pay rate, recognize that in the period of the change. So in that example, December 31st year end, if they get a pay raise on January 1st, you recognize it on January 1st in that fiscal year. Compensated absences that are paid to an individual account instead of directly to an employee basically should be included in the liability for compensated absences. So this would be if there's a payment to an individual account and then those amounts are used to pay like health insurance premiums in the future. If that's the case, you want to include that in the compensated absences. Next bullet point doesn't really change from statement 16. So for financial statements prepared using the current financial resources measurement focus, you're only going to recognize that expenditure to the extent that it's liquidated with expendable available financial resources. So what that usually is the employee separated before year end. So your December 31st, they left before December 31st, but the compensated absences weren't actually paid out until after December 31st. So that's typically when you would record it directly into a governmental fund. And then when determining more likely than not to be used for time off, definitely helpful to look at the classes of employees instead of the population as a whole, especially for larger governments, and especially for sick time. I always say there's two types of people in this world: people who use sick time as vacation days and those that never use it at all. So you'd be really surprised, in my experience, with how different the usage rate is by class of employee. It can be really, really different. So if you have a larger government that's got several classes of employees, maybe you have a lot of collective bargaining agreements, you want to look at it most likely by a class of employee to come up with a correct utilization rate. And this is the good news: no new note disclosures. So that's pretty exciting. And then there's two exceptions to guidance under GASB 34 that you no longer need to follow for compensated absences. The first one is you can have there's an option to present net increases and decreases instead of gross amounts. You just have to indicate that what you're presenting is a net amount. So for those of you that participated in the GFOA certificate program, you'll know that this was one of their all-time favorite comments was, you need to show changes in compensated absences as gross. So no longer need to do that. Just make sure that you're noting that it's a net amount. And then also, you're not required to disclose which governmental funds are used to liquidate compensated absences anymore. So that's also a requirement of 34 that you don't need to apply to compensated absences now. So like I said, effective date, we're kind of right in the middle of it. So it's December 31st, 2024 and later. And the last thing I'm going to cover, like I said, is just some implementation and ongoing accounting tips. The first bullet point is the most important point. So you need to take as much time as you need to review and document your current compensated absences policies. And a lot of larger governments are going to have numerous policies based on employee class or collective bargaining agreements. So if you get it wrong here, everything that follows afterwards is going to be wrong. It's kind of the old garbage in, garbage out thing. So take as much time as you need to review and document the policies, so you're capturing the compensated absences correctly. As I said previously, you want to look at, I would say 99% of governments are looking at historical data on usage. Typically for the past 2 or 3 years, most of them look at 3 years of information. And like I said on the previous slides, you probably want to review it by employee class, because, like I said, there are large variances in usage by class. And then once you come up with that usage amount, compare that usage to the beginning accumulated balances or the annual allowance to develop a usage percentage that you're going to use for your compensated absences balances. I always say you're kind of in the details and the weeds coming up with these spreadsheets to determine the usage percentage, the more likely than not to be used. When you're done, take a step back and just see if it makes sense, if the percentages make sense, and the liability balance appears reasonable. Because a lot of times you'll do it, you'll come back and say, that's really, it's too high, it's too low. So just take a step back, look at it from an overall perspective, and see if that percentage is correct. And then, review the usage percentage on an annual basis going forward. Just want to make sure that there's no big changes in usage going forward. It should year to year be pretty much the same, but you want to take a look at that every year. One thing that you could do that I haven't really had any governments that I know of used, but you could look at recent retirees and see kind of what they forfeited or walked away from, what percentage that is, and come up with some type of percentage that way too. So that's an alternative procedure, but I haven't really seen that used in practice. Pretty much everyone's just looking at historical usage. I'll give you my 2 cents on FIFO versus LIFO. So first in, first out, last in, first out. At first glance, if you look at LIFO, you might think it's like an easy button. Like you can say, well, whatever they earn in the future is going to be more than what they use. So therefore, I don't need to record any liability. But you'll need some type of calculation that supports that, and your auditor will most likely need some type of support for that. So when you think about it, it's still going to be a pretty complicated calculation, maybe even more complicated to calculate, because you're going to have to look by employee, or at least by employee class, what the remaining service life for that employee is, then an estimate of what they're going to earn in the future versus an estimate of what they're going to use in the future, and then compare those. So if you're going to earn more than you use, then the liability would be zero. If it's reversed and you project that they're going to use more than they earn, then you've got to book some type of liability for that difference between the two. So it's kind of like with inventory, you're kind of eating into that LIFO layer. So basically, you'd have to record a liability in that instance. Like I said, you have to support that, and the calculation might be more complicated. So I almost all the governments that I know of are using the FIFO method. So that's my 2 cents on that one. The last thing I'll say is just document the assumptions and the methodology that you used, and then just consistently apply it each year. So each government's going to calculate it somewhat differently. There's no right or wrong answer. There's no one size fits all. But as long as you have sound assumptions and methodology, and you just consistently apply it each year, you're going to be fine. So that is all I have. I'm going to turn it over to Matt, who's going to talk about some tips on the implementation side.
All right, thanks, Jim. Well, as Jim had mentioned too, since we're in the thick of this implementation cycle, 1231, 24s have gone through this. And we did have a couple of entities that early adopted this provision too. What I'm going to, on the next couple of slides, is walk through a couple of common issues, things that we saw in practice, and some heads up on what to do or what not to do before we start thinking about the case studies. So this is more of the practical application of adoption of this standard too. And in the grand scheme of things, this standard wasn't nearly as complex as, say, 68 or 75 and deal with actuarial calculations, which, thank goodness, right? We all had enough of that, so we still have to deal with that on a go-forward basis. So, but at the same time, it does require a little bit of thought. So a couple of things that are out there. The first, common issue we saw was that only a portion of that leave is eligible to be paid out at termination. So 50%, right? That kind of goes back to what the standard says specifically about if you're getting settled at a rate different, a rate that's different than your rate of pay. That's where you actually have to, take that rate of pay and then apply that to the liability, because the fact that you're only going to get paid out 50% at termination. But the issue isn't just, well, that's just a cash settlement, so that's the liability. That's only part of the deal here. You still have, a portion of that time that it's been earned and accumulated where over time it's going to get used. That's the big thing. Bullet number 1 in the definition of a settlement is usage in the normal course of operations. So, you have to make sure that, yes, you're considering the cash payment value, but then also theoretically what people are going to use over that time. That goes into the liability calculation. So you can't just skip it if there's a cash payment. So, and then you also have another situation where only certain employees meet the criteria to be paid out of termination. Well, because of that, only those employees, in theory, are going to be, that's the liability. Again, not true, because at the same time, these employees are using their time that they have earned over the course of operations providing services to the entity. So because of that as well, that liability has to include a piece of it. Now, if only certain people are getting cash at separation, that piece of the liability is probably going to be a little bit smaller than you might have as opposed to if everybody's eligible for cash. But again, you have to consider those nuances. And the other big trick of that, of course, is that since you have multiple employee classes, if you have let's say, a very large municipality, you're going to have people on a municipal contract, you're going to have people in public works, you're going to have people in police and fire. They all are going to, typically are going to get different types of severances and, settlements based on their negotiated collective bargaining agreement. So you have to make sure all that's considered into the calculation as well. So now if you have a situation where, again, employees can only be paid, they can get paid out upon separation, but only up to a certain amount. Well, that's great. Yes, that max limit applies to the calculation just like it had previously. But again, that usage that needs to be baked into the calculation, that has to be included as well. And I already talked about employees under various policies because of the fact that, that's where this calculation, for smaller units of government, it may not be all that particularly complicated, but if you're dealing with large units of government, large cities, large villages, counties, with multiple different classes, that's where this can get very interesting. So the leave is converted to service credit, which we used in this example. If you are in Illinois, if you are, your sick time unused at retirement can get converted into service credit into the Illinois Municipal Retirement Fund, which is a defined benefit agent multiple employer plan. Well, because of that, that amount of that leave that has been earned, that since it's getting, converted into a defined benefit pension plan, we exclude that from the compensated absences calculation because of the fact that the actuary typically is including that in the 68, or in this case, GASB 68 calculations. So it's important to make sure that we understand that as well. And then, of course, you could have a piece of that could be forfeited as well. Now, if you have unlimited leave, that's something where it gets a little interesting here, is because with unlimited leave, you don't necessarily know what exactly the leave is going to be. So, if somebody has a bank of unearned leave, you're not going to record anything until the leave is actually used. And when it's actually used, as a reminder, that's when we're going to start calculating a liability. The thought is, what if you have unlimited leave, but then it's only capped at a certain, settlement amount? So, that's where you have to consider, okay, according to the policies, what is it they've earned? What's the maximum amount that they could get settled? So, and then before that as well, you're also looking at the maximum amount that could get settled versus also the usage as well. Again, some of those calculations have to be considered using historical trend information. Something Jim mentioned when it comes to historical trends is also looking at things that are happening that could throw off the historical trend. A lot of entities have been using 2 to 3 years as a good, judge of what their usage policies are. And that's not right or wrong. Gatsby was very deliberate about making sure that there was flexibility in the way the calculations are run, because each government is going to have different experiences, they're going to have different structures, they're going to have different policies. But let's say there is an event that universally is causing, chaos when it comes to usage and employee absences. Prime example, the pandemic, right? Well, it may not make sense to use some of those pandemic era usage rates because they may be artificially high, or if we're using sick time, that may be artificially high, vacation time may be artificially low. Again, that might throw off the averages and may not be considered reasonable. So that's something to keep in mind as well. Again, having a discussion with your auditors on what's reasonable and make sure that it's documented with your assumptions is the key to this whole thing. Sporadic leave, parental leave, military leave, etc. too. Again, we're talking about very, very small populations of your employees. So that's something where it may need to be considered as well. It may not be material to the financial statements. One thing GASB includes in all of its standards is a box that says this standard need not apply to immaterial items. So, if we're talking about this, periodically here and there, and if you're calculating this by employee class, you're right, you may not need to go down to that granular level of detail. But if you're a smaller entity and you are going down to that individual employee level because you have the data, that's something you have to think about as well, as far as what you're actually going to record as a compensated absence. You're not going to record parental leave or military leave in advance because you don't know when it's going to happen. It's sporadic for that. All right, use it or lose it. Just had a conversation with a colleague about that this morning and how you deal with that too. Now, use it or lose it, at the time when you look at the definition of a compensated absences, it has to be, for services earned, it has to accumulate, and then of course more likely not to be settled, right, in cash or other form of settlement. So, if you have to use it or lose it, you've met the criteria. So during the year, the obligation is present. But then at the end of the year, if it's gone, that liability, because the fact they didn't use it, so essentially it's being forfeited, at the end of the fiscal year for reporting purposes, you may not have much of a liability report. Maybe you have somewhere, the time had been earned, but it hadn't been paid out to the next fiscal year, kind of using Jim's example about, employee who was severed during the year, but the check didn't get cut till the next year. So you could have a very small liability for situations like this as well. Another common issue with that is, well, what happens if you use it or lose it, and then let's say on January 1st of the next year, assuming you have a December 31st year end, and you have, your bank gets reset. So everybody just gets 20 days on day one, and you can use it during that time. If you don't, you'll lose it. So, well, the liability at the beginning of the year is technically zero. The reason is because, and this is something GASB actually brought up specifically in their implementations, and you think about it, and is that what happens is that the time on day one, it has accumulated, but as the employee rendered the services to earn that time. on day one? The answer to that is no, they have not. So in that case, there's nothing to record on a liability on day one. And then, if you were recording a liability over time, that's how you would recognize it, because it had been earned. Okay, so a couple of other fun things to think about when it comes to implementation of this as well is also, what is your fiscal year? Is it a calendar year, or is it a fiscal year, like a 6/30 or a 3/31 or whatever the case may be? Just because obviously in government we have a whole variety of fiscal year ends too. You have to consider when that time is earned. If there's a use it or lose it consideration, when is that time reset? When does the bank get earned? So because of that, you have to think about specifically, in accordance also with the policies, of what are you doing with this as well? When do you recognize that liability? And at your fiscal year end, it may be a little bit different than a calendar year end. And it kind of ties into the next bullet, which is, if you have leave, it's paid out at the end of the year, because instead of, okay, you've earned it over time, and then the leave is paid out. So let's say your fiscal year end is December 31st. On December 31st, everybody gets a check for time that has been earned, it has accumulated, but it just wasn't all used. So in that case, you have the expense that is out the door. Well, you don't have a liability per se, because the obligation was settled on December 31st. You have the expense, and that's been recorded. So you move on with you move on with your life. So in that one, so that can cause a little. It could make your life a little bit easier. Of course, though, when it comes to dealing with policies, and if you're paying out leave at the end of the year as well, of course, it has to be in line with your policies as well. And something else to think about as well, depending on the state, is that if you're going to make a change to your compensated absences policies, and it's impacting somebody as far as leave or settlement, or maybe it's perhaps taking away part of that benefit as well, you may have to think about this on a prospective basis. Typically, legally, you can't go back and take away time that has been earned by the employee without settling it. So that's usually in violation of labor laws. So something to keep in mind as well. Okay, salary-related payments. This applies for all employees that are eligible for this as well. And typical when again, if you think about what is a salary-related payment, we're talking about FICA, we're talking about Medicare. So we're talking, those are the two common ones as well. That has to get baked into your calculations for your liability. And in previous iterations, it may have been missed. So when it comes to implementing a standard, this is I guess you can call it a get out of jail free card for going back and correcting this without calling it correction of an error, because you're just merely adopting an accounting policy change, an accounting principle change, which under GASB Statement 100 is required for retro unless they specifically say, don't. In this case, GASB specifically said this is a retroactive restatement based on the earliest period presented. So the data that's used to support the estimate. There's a lot of variety, and there's a lot of issues that pop up with this as well. Well, should I be using, the trend on, the historical bank for vacation? Should I do it for sick? Should I do it for, how far do I go down there? It kind of ties into the next bullet about what level of data should be applying. Do we do it at population, a sample, individual employees? Again, GASB was very specific to not put in guardrails on this. It's because of the fact that every entity is different. They're going to have different approaches, different policies, different types of employees, different usage percentages. So that's going to be something where the key to that is make sure that you've documented your assumptions on why you're doing it and why you believe it's reasonable. Jim mentioned the step back approach when it comes to looking at the data, and I wholeheartedly agree with that and encourage my clients to do that. Step back and say, does this make sense? If you're calculating a liability of, let's say 2% of the usage of your bank during a fiscal year, and you're seeing, for some departments it's 25%, and some departments it's 3%. You're seeing it all over the board. It may not make sense to use a standard usage percentage across the board because it's not indicative of the population. You may need to bifurcate it down to some of those department levels. And then, of course, if you're doing a sample of employees, which is perfectly acceptable to do, when we audit, we are auditing using samples of calculations. We're not recalculating the whole thing unless there's a material reason to do it. So a sample is perfectly acceptable to do that, but then again, you need to make sure you're documenting it, how you did it, and why it makes sense. It kind of also goes back to the whole, Jim mentioned too, as far as the level of data, documentation of assumptions, the step back approach, especially when you apply to things like FIFO versus LIFO. The LIFO calculation, as Jim had mentioned too, it's a lot more complex because you have to think about not only looking at the historical usage calculation, but you also then have to start thinking about forward projections as far as what do we think they're going to earn, what do we think they're going to use, what's their service life going to be. It's applying additional calculations here. So it may not make sense to do that as well. Again, it's not the easy button. Yeah, there's usually typically more work to do. But if you're going to do that, step back. May see why this makes sense. So that's the important piece when it comes to thinking about this particular standard and the implications of this. So, okay, so that's enough about when we're thinking about common issues, obstacles, questions, because those are the common ones we've seen so far. So we're going to do a little bit of math here, and we're going to be using an example from a case study that Sikich published. And we're going to talk about a municipality. Now, as you can see in the next slides, again, this is purely a fictional entity as well. This was not taken from an actual client. But it's going through and how the math would work in a situation like this. So, for our example, City of Sample. Great catchy name, right? So we're using a calendar year as its fiscal year. So again, in this particular case for case studies, case studies you typically like to try to keep it somewhat simple. We know there can be a lot of nuances and very complexities here, but for this case, we're just going to keep it somewhat simple. So calendar year equals the fiscal year end. You have policies in effect that include just two types of leave. We're just going to say sick leave and vacation leave, the most common ones as well. Obviously, there can be compensatory time, sabbaticals, but we're not going to do that. So, and the big thing here, which kind of goes back to what we want is things to think about, is the fact there are separate employee policies. One is for your union employees working in a non-public safety department, clerk's office, city manager's office, public works, building department, the finance department. So they're under one set of guidelines here under their policy. Public safety is going to be the other policy, police and fire. Now, a lot of times we know that police unions and fire unions are two separate, distinct unions. They often have separate pension plans. They often have separate, union contracts. But for purposes of this example, we're just going to look at them as these two types as one type, but looking at differently compared to the municipal entities as well to kind of highlight what you have to think about here. All right. Now, when it comes to our municipal employees, they earn sick and they earn vacation as they provide services to the city. And then settlement of sick and settlement of leaves, it does occur. Obviously, it's used in the course of normal operations, so that's pretty normal, right? Everybody's going to, you earn the sick time, you earn the vacation time. People are going to use it. That's what they do. Jim had mentioned too that vacation time often is used, it's going to get used. Employees like to take vacations. I like to take vacations. Everybody does. So sick time a little bit different. Jim had mentioned some employees don't like to use all their sick time. I'm one of them. I don't like taking sick time because usually I just find more work waiting for me. But some employees will use their sick time as well, and they will bank it if they're allowed to as well, and use it for future instances as well. Depending on your department, so maybe municipal employees aren't using their sick time as much, but then maybe some departments that are more wear and tear on their bodies physically, such as public works, police, and fire, may use their sick time a little bit more. And this is different than disability payment, short-term or long-term disability. So we're talking about just true sick time as it meets the definition. So One of the other forms of settlement is the fact that payment in cash at termination for any accrued but unused vacation time at the full hourly rate of time. So, okay, that's the first piece. Now look at the sick time, the next bullet. Our unused but accrued sick leave is not paid out in termination. So again, that's something to think about here. And this is where previous guidance under GASB 16 was different because under 16, we would accrue liability for the vacation because it was paid in cash, but we wouldn't do anything about the sick. And now under GASB, this particular GASB statement 101, well, now you have to start thinking about this because the fact that it's not paid out in cash doesn't mean you're off the hook. And since they're not allowed to pay out in cash at separation, they can convert any of their time into service credit of their employees' defined benefit pension plan at 1/2 of their hourly rate. Now, typically with these types of plans, if we're talking about a statewide plan, like an agent multiple employer plan or a cost sharing plan you see for a lot of municipal entities, that's often governed not only by the individual entities, but also by the statewide policies of what they can and can't do, often set in law. So vacation time, not subject to conversion. You just get that in cash. So based on that situation, a couple other things. We talked about the municipals, public safety, a little bit different. The employees earn their vacation and they're sick as they're providing services to the city. Settlement of sick and leave includes use, but then also both of them get cash. So upon severance, unused but accrued vacation and sick, you do get paid out in cash. But since these employees are getting paid in cash, they are not allowed to convert anything into a defined benefit pension plan. So, and there is a defined benefit pension plan here. It's a single employer plan for purposes of this example. So a couple of those nuances to think about. So public safety settlement's a little bit different. They get cash for everything, but no conversions. Whereas municipals, they get cash for one, not cash for the others, but that other one they get conversion. So now, another assumption is that we are encouraging our employees to use their allotted sick and vacation time, but otherwise, there is no forfeiture for earned leave. So no use it or lose it other than if there's any amount that for a termination or a retirement, which theoretically may not be subject to settlement. Another thing that happens very commonly is also with the department heads. Department heads may not be specifically permitted to join a union, so they may not be governed by a collective bargaining agreement that their union member employees are. However, but in this particular case, we're going to say that they follow the compensated absence policy in the departments just for ease of reporting purposes as well. Everything's tracked in the ERP system, which is great. We don't want accounting records for such as comp abs times pulled off into separate records as well. You may need to use Excel to come up with the calculations for the liability, but you don't want to store that in a separate thing. Typically, you want to restore that in your payroll system in the ERP. And we're also saying no changes in policies during the year of adoption under GASB 101. Again, just to make our lives a little bit easier. So, okay. So with that comes to our next polling question. So let's go ahead and open that thing up before we start walking through the case study. Now, in this particular case, what types of paid leave are allowed to accumulate under your organization's policy? Not necessarily what is in our example. What are you guys seeing out there as well? So, all right, what do we got here?
The votes are coming in. So I will leave it open until we have about 90% response. And again, make sure you get this answered for CPE credit.
All right. So interestingly, as we are coming in, Rachel, you can close the poll when you're ready to, but vacation leave and sick leave, the common ones, I would expect, personal leave as well, and some other as well. A couple of entities that said none of the above. That's interesting. So again, it's not impossible. You can definitely have an entity that maybe perhaps you're not getting paid leave at all. Again, though, some depending on where your entity is located, you may be in a state that does mandate sick time or vacation time. So there may need to be a change based on laws and regulations as well, but that's interesting. So, okay, so let's go through our case study as well. So as I mentioned before, for our sick leave for municipals, it's used in the normal course of operations. Previously, under the previous guidance, we weren't recording anything. Now it's required under the more likely than not usage. So what the city did in this particular example is that they did an estimate of sick leave usage by looking at 3 years historical data on an average usage for a sample of 10 employees for the municipal side. It included employees with at least 3 years of tenure and higher, so they could get good historical data as well. And that percentage usage was very specifically defined as hours used in the period divided by hours earned in the same period. Again, there's no requirement saying you can do hours usage divided by hours in the same period. That could get you a higher percentage, let's say, versus hours used divided by hours total in the bank. That could get you a lower percentage. It may be acceptable, but you have to think about that as well and think about, is it realistically reflective of what's happening as well? So, and then we take that more likely than not percentage usage times the sick leave hours at the beginning of the end of the period. The reason beginning of the period is because of the fact that we're adopting the standard as of the earliest period shown. We're just going to say 1 year. We're not doing comparative financial statements. So that's why you've got to do this calculation for adoption twice. Beginning of the year, end of the year. Now, if employees are settled upon cash or termination, in this case, well, for the municipal employees, they don't get cash or some. So therefore, we're just going to exclude that from the liability because they don't get anything. So, and also, if there's any sort of conversion of that time into the defined benefit pension plan, then we have to make sure that we are excluding that from the calculations as well. So, okay, let's see here. Where are we here? I want to make sure we have enough time to walk through this as well. So, all right, now for our example here, this is a smaller municipality, so we had just 20 employees. So we did 20 employees, and you can see by the various departments we have, and you can see what is their hours earned, their hours used, and what's the balance. And also the pay rate at the beginning of the fiscal year, and the end of the fiscal year. End of the fiscal year, we're talking about 12/31/2024. So that's our example calculation. And all this is built into the slide that you can now pull out separately. And what we did here is just did a sample. We did just 10 of those. So we just 10. We arbitrarily said, hey, that sounds like it's a pretty good number. And we looked at it, and we looked at the percentage. We calculated, okay, 2022, the usage was around 62% of the hours earned in a calendar in a period. 2023, a little bit higher, 55%. And then at 2024, we said 56%. So when you look across those 3 years, we came up to an average around 58% of basically what's earned. They're using about half of that. So they're going to be building up, comp apps over time. But it's interesting, as you can see here, is that the hours earned is the same. The usage percentages definitely, some employees are using 60 hours in a calendar year. Some are only using 16 hours. So again, that's why it's important to make sure that you're understanding what your data is telling you to specifically tell whether or not it's realistically a valid number. So when you apply that calculation, you are then applying, okay, here are the hours balance, and we're applying our usage percentage, 58%, for all 20 employees, and then you calculate what's the leave. So hours times rate, the adjusted hours based on the usage percentage, and we're adding Medicare and we're adding Social Security for the total liability. So in this case, we came up with $117,000 as the total liability as of 12/31/2023. It's a beginning balance. And then we looked at our calculation and said roughly 56% of that's going to be used in a calendar year, in 1 year. So that was our estimate. So based on that, we do the same exercise for 2024. And that's how we came up with our ending balance of actually being $135,000. So it went from 117 to 135. Now, let's look at our vacation studies. And I'm going to go a little bit quicker here because we're getting a little close on time. I want to make sure we discuss this as well. So are cash payments at termination. Well, in this case, since everybody's getting settled, either you're going to use it or you're going to get paid out. So 100% of your vacation is already included as a liability. We're not changing anything. You're only going to really think about a usage percentage for the amount due in 1 year. So that makes life a little bit easier. That's typically what we're seeing in practice as well. For our sick leave, again, the sick leave, their folks are getting paid out 100% in cash or they're using it. So again, and there's no conversion as well. So therefore, the liability we previously been recording, it's still a valid liability. So moving forward there, when it comes to your sick time, we just looked at our usage percentage. And then in this particular case, you can see our sick time, public safety employees are using a lot more of their time. So this is where it makes sense to look at the data in different buckets because one, the rules are different, but the usage percentage also is very different here. So, all right. So let's keep going here. So once we apply that usage percentage, we're looking at the beginning balance, and then we're looking at our ending balance here as well. So what we're going to end up doing then is taking our calculations here. We have our balances on the liability. We have this broken out into what's the sick leave, the sick leave and the vacation leave for the applicable buckets, municipal and public safety. Then we have the balances that were revised based on this as well. And then we're going to calculate basically what's the difference. So the first journal entry we're going to book here, which is on the which I'm going to show on the next screen, is going to be it's going to be a restatement of the liability because, in fact, we have to account for that. And it's going to go against equity because, in fact, it is an accounting change. And then you're also going to then flow the current year's information, run that through expense. And you're going to do that by function, by the general government function, the public works function, public safety function as well. So that's how our journal entries, as you can see on the screen, are shaking out here. We're at, we had $138,000 we have to put on the books because of the new liability that's on here as well. And then we have to adjust the liability for the current year's activity. And then what we're going to do is then in our footnotes, the biggest thing you want to make sure is in your summary and significant accounting policies, you're very specific to talking about that. Yes, during the year, this fiscal year, you adopted Statement 101. And because of that, what you're recording as a liability is different than you previously reported to the users of the financial statements. So you can't just say that, the sick time is not recorded when now going forward it is. So you have to disclose that information. Our example here is pretty good because we've talked about how the fact that the policies have changed, the fact that vacation time is used, sick time is a liability if it's more likely than not to be used or settled in cash, and then the liability is incurred in the financial statements as well. Okay, I'm going to jump ahead a little bit here just to talk about how that presentation, the footnotes, as you can see, it's a net number, and we specifically have highlighted here on the screen how we've disclosed to the users that this is a net change. No discussion of what fund, because you don't have to do that anymore. So let's get to our last polling question because I want to make sure we get that done and taken care of for CPE purpose. So Rachel, why don't we go ahead and launch the poll? And then while that's going on, let's see here. Do you have vacation or already planned this year? Well, I do, so that's great. Looks like a lot of folks do too. So why don't we go ahead and while that keeps going here, I'm going to take a look. I think we did get a question. So I'll talk about that one specifically when we get to the end as well. So I want to make sure we cover all that.
And again, one final reminder that last poll is needed for CPE credit. I'm going to close this poll momentarily.
Okay. So most folks are taking a vacation or going to be taking a vacation or not sure. Nobody said no, which is good. All right. Now, here's another example that I said we don't have a whole lot of time to get through this one. So briefly, one thing I want to highlight here is that certain criteria meet certain employees only meet the criteria for settlement of sick leave at termination, and they calculate the usage percentage 3 years by looking at the hours used divided by the accumulated hours. So therefore, the percentage usage is going to be smaller than our case study that we did previously. And that you can see here on the screen as well, is the fact that some of these percentage usages for various departments such as engineering and fleet services, IT as well, we're talking 3%, 10%, 5%, different than 20% or even 90 some odd percent that was coming up in the case example. Again, this could be perfectly acceptable based on your facts and circumstances, but you have to make sure you can support it and make sure that it's reasonable and you understand why it's happening. So when we did our example here, we have our math calculation where we're looking at, we did the calculation in buckets. So we have the total bank, as you can see on the far part of the screen. We have the amount that's likely to be used, so that's settlement, yes. But then also, if somebody's going to get settled upon termination, that eligible for payment value. So you can see not a lot of employees met that, so therefore that's not picked up into the calculation as well for everybody. So certain people it is. So, okay. So we're just about out of time. So I wanted to leave this open for just final Q&A as well. So, our contact information is on the screen as well. Please reach out if you do have questions as well. So let's take a peek at the chat and the Q&A. I think I did see one that I did want to cover. So, all right, Jim, here we go.
Yeah, I think there was a question on IMRF, I think.
All right. What do we need to include employer IMRF as well as FICA to the total liability if we are an IMRF employer? So we're talking about, do you have to include the employer IMRF contribution specifically into that compensated absence liability? Basically, what's the salary related payments? So now IMRF is a defined benefit pension plan. So, from my understanding is that no, you're not going to include that as well because the employer contributions is going to be separately baked into the calculations as far as what the GASB 68 liability is going to be. Jimmy, see any other questions?
That looked like it. Yeah, I didn't see any others.
Yep,
All
that
right.
was our last question.
Great. All right. Well, thank you everybody for your time and your attention today. So, Rachel, why don't you go ahead and you can wrap us up?
Yep. So thank you again for joining us today. Thank you to our facilitators. You can keep an eye out in your email for that certificate coming your way within the next week or so, and then also that email for on demand so you can review the recording again. Make sure you download those materials that are connected, and have a wonderful rest of your week, all.